Warren Buffett is one of the most successful investors of all time, and his value investing strategy has made him billions. In this video, we will explore how Warren Buffett chooses his stocks and what his key principles are. Value investing philosophy. Warren Buffett is a value investor, which means he focuses on the intrinsic value of a share instead of technical indicators. His company, Berkshire Hathaway, looks for consistent earning power, a good return on equity, capable management, and sensibly priced shares. Buffett uses several key considerations to evaluate the attractiveness of a possible investment. Performance. Buffett looks for companies that have been providing a positive and acceptable return on equity for many years. The longer the number of years of good ROE, the better. He also compares a company's historic ROE with the ROE of the company's top competitors in the same industry. Debt. Buffett prefers earnings growth to come from shareholders' equity instead of debt. A company with positive shareholders' equity means the company generates enough cash flow to cover its liabilities and is not relying on debt to keep it afloat. Low debt and strong shareholders' equity are two key components for successful stock picking. Profit margins. Buffett looks for companies that have a good profit margin, especially if profit margins are growing. To stay on Buffett's radar, a company's management should be adept at growing its profit margins year over year, a sign that management is also good at controlling operating costs. Unique products. Buffett considers companies that produce products that can easily be substituted to be riskier than companies that provide more unique offerings. A company's unique product could be a competitive advantage that helps it earn profits through greater sales and margins. Discounted shares. The crux of value investing is finding companies that have good fundamentals but are trading below where they should be. The greater the discount, the more room for profitability. The goal for value investors like Buffett is to discover companies that are undervalued compared to their intrinsic value. Conclusion. Warren Buffett's value investing strategy has made him billions. By focusing on a company's performance, debt, profit margins, unique products, and discounted shares, Buffett is able to uncover long-term profitable investments. His key principles include investing in yourself and having good financial practices. By following his strategy, you may be able to achieve investment success like Warren Buffett. In conclusion, Warren Buffett's value investing strategy is key to his ability to pick profitable stocks. He looks for companies with consistent earning power, good return on equity, capable management, and sensible pricing. He also focuses on companies with healthy and growing profit margins, unique products or services, and that are undervalued, offering room for profitability. Buffett's approach to evaluating a potential investment involves analyzing a company's historical performance, particularly their return on equity over many years, comparing it to their competitors, and reviewing their debt-to-equity ratio. He also assesses a company's profit margins over several years, their unique products or services, and whether their shares are trading at a discount compared to their intrinsic value. While there is no exact formula for calculating intrinsic value, investors will look at various factors, such as corporate governance and future earnings potential. Warren Buffett's investing principles include investing in oneself, having good financial practices, such as managing debt, and avoiding fads and speculation. By following these principles and his value investing strategy, Warren Buffett has built a massive net worth and a reputation as one of the most successful investors of all time. In addition to his value investing strategy, there are a few other principles that Buffett follows when selecting stocks. One of these is to invest in companies that he understands. By investing in companies that he can easily comprehend, Buffett can better gauge their potential for long-term profitability. Buffett also looks for companies that have a competitive advantage or a moat. This means that the company has a unique product, service, or business model that is difficult for competitors to replicate. By having a competitive advantage, a company can maintain its market share and profitability over the long term. Another principle that Buffett follows is to avoid market trends and fads. Instead of investing in the latest, hot company or industry, Buffett focuses on long-term investments that are likely to provide steady returns over time. Finally, Buffett believes in holding stocks for the long term. He has said that his ideal holding period for a stock is forever. By holding stocks for the long term, Buffett can avoid the short-term fluctuations of the stock market and benefit from the long-term growth of the companies in his portfolio. In conclusion, Warren Buffett's value investing strategy is key to his success in picking profitable stocks. He looks for companies with a good return on equity, healthy profit margins, a competitive advantage, and undervalued shares. By following these principles, Buffett has been able to consistently generate long-term returns for himself and his investors.